Mortgage rates don't usually jump in a way that feels sudden to most people. They tend to move gradually, almost quietly, shifting a little here and a little there as the broader economy changes. But every so often, something shifts underneath the surface, and those small movements turn into a noticeable spike. That is exactly what just happened. Mortgage rates climbed again, reaching levels we have not seen in months. And for anyone thinking about buying a home, refinancing, or even just understanding where the housing market is headed, it raises a very simple but very important question. Why now, and why so fast? At first glance, it might not seem like a big deal. A fraction of a percentage point increase does not sound dramatic, but in the world of mortgages, small changes can have large effects, because when rates go up, monthly payments go up, and when payments go up, affordability changes immediately. A home that felt just within reach can suddenly feel out of range. That is why these shifts matter so much, even if the numbers themselves seem small. To really understand what is happening, you have to look beyond housing itself. Mortgage rates are not set directly by banks in isolation, and they're not simply controlled by central banks either. Instead, they're closely tied to long-term interest rates in the broader financial system, especially government bond yields. Those yields move based on what investors believe about the future, not just where the economy is today, but where it is going. And right now, one of the biggest things shaping those expectations is inflation. For a while, there was growing confidence that inflation was cooling. Prices had been rising more slowly, and there was a sense that the worst of the inflation surge might be behind us. That optimism helped keep long-term rates relatively stable. But then something changed. New concerns started to emerge, and much of that shift came from a place that affects almost everything else in the economy: energy. Oil prices began moving higher again, and that may sound like a narrow issue, but it's not. Energy is deeply connected to nearly every part of the economy. When oil prices rise, transportation becomes more expensive, shipping costs increase, manufacturing costs rise. Even food prices can be affected because agriculture relies heavily on fuel and logistics. So when energy prices jump, it creates a ripple effect that spreads far beyond gas stations. That ripple effect feeds directly into inflation expectations. Investors start asking a different question. Instead of assuming inflation is under control, they begin to wonder if it might stay elevated for longer. And once that question enters the market, behavior changes quickly. Investors demand higher returns to compensate for the risk that future dollars will be worth less. That means bond yields go up. This is the key connection. Mortgage rates follow those long-term yields, so when bond yields rise because of inflation concerns, mortgage rates rise with them. It's not a direct decision made overnight. It's the result of a chain reaction that starts with expectations and moves through financial markets before finally reaching borrowers. But inflation is not the only factor here. There's also the role of uncertainty. Markets can handle clear trends, even if those trends are not ideal. What they struggle with is unpredictability, and right now there's a growing sense that the path forward is less certain than it seemed before. Energy prices are moving, global conditions remain complex, economic signals are mixed, and when uncertainty increases, investors tend to become more cautious. That caution shows up in higher yields, it shows up in wider spreads, and ultimately it shows up in higher borrowing costs. Mortgage rates are one of the most visible ways that this caution reaches everyday people. What happens in bond markets and global energy flows eventually lands in the monthly payment calculation for a homebuyer. Now, when rates rise like this, the impact on the housing market is immediate but not always simple. The first and most obvious effect is on affordability. Higher rates mean higher monthly payments for the same loan amount. That reduces the number of people who can comfortably afford to buy at current prices. Some buyers step back, others lower their budgets, some delay their plans altogether. But housing markets don't adjust instantly. There's often a lag between rising rates and changing prices. Sellers may still expect strong offers. Inventory may remain limited. Buyers who are already in the process may still move forward. So instead of an immediate correction, you often get a period of tension. Demand softens, but prices don't fall right away. Activity slows down, but doesn't stop completely. This creates a kind of friction in the market. Buyers feel squeezed, sellers feel uncertain, transactions become harder to complete, and the overall pace of the market can shift without a clear direction at first. That's often what makes rate spikes feel so disruptive. It's not just the numbers changing, it's the way those numbers affect behavior. There's also a psychological element that cannot be ignored. When rates move quickly, it changes how people think about timing. Some buyers feel pressure to act before things get worse. Others become more cautious, waiting to see if rates stabilize or fall again. That shift in mindset can influence the market just as much as the rates themselves. At the same time, lenders and financial institutions are adjusting their expectations. Higher rates can change demand for loans, alter risk calculations, and shift the overall lending environment. So the impact is not limited to buyers and sellers. It flows through the entire housing finance system. And then there's the broader economic picture. Housing is a major part of the economy. When mortgage rates rise, it doesn't just affect home purchases, it can influence construction, home improvement spending, and even consumer confidence. People tend to feel the impact of housing costs very directly, so changes in this area can shape how they think about their overall financial situation.
This is why a move in mortgage rates can signal something larger. It reflects how markets are interpreting inflation, energy prices, and future economic conditions. It is a kind of real-time feedback loop, where expectations about the future are constantly being updated and priced in. Looking ahead, the big question is whether the spike is temporary or part of a longer trend. That will depend on what happens next with inflation and energy markets. If oil prices stabilize or fall, some of the pressure on inflation expectations could ease. That might allow bond yields to settle, and mortgage rates could follow. But if energy prices remain high or continue rising, and if inflation proves more persistent, then rates could stay elevated for longer. There is also the question of how policymakers respond. Central banks are watching these developments closely because their goal is to manage inflation without causing unnecessary economic strain. But their actions take time to work through the system, and markets often move ahead of policy decisions based on expectations rather than outcomes. So in many ways, what we are seeing now is the market adjusting to a new set of possibilities. The idea that inflation might not fade as quickly as hoped, the possibility that energy prices could continue to create pressure, the recognition that the path forward is less certain than it appeared just a short time ago. And when those possibilities change, mortgage rates respond, not because of a single decision, but because of a complex interaction between expectations, markets, and real-world conditions. It is a system reacting to new information, trying to price in what comes next. In the end, the sudden spike in mortgage rates is not random, and it's not isolated. It's the visible result of a chain reaction that begins with inflation concerns, flows through energy markets, moves into bond yields, and finally reaches the cost of borrowing from millions of people. And once you understand that chain, the movement makes more sense. It is not just about housing. It's about how the entire economic system is adjusting to new pressures and new uncertainties. And mortgage rates are simply one of the clearest signals of that adjustment.